Hello YouTube and welcome back to the channel. Today I'm going to go over the dividend portfolio and I made some updates to presentation that I hope you like. So this is a dividend portfolio. The intention is just education, entertainment. This is not financial advice. Seek a financial professional before making any investment decisions. I wanted to show what a dividend portfolio could look like. So if you're following along, I'm showing the funds that I'm holding and pretty much how they're doing and what the dividends are for the portfolio. So, uh, kind of some background, and this is based on owning assets, building a lifetime of financial freedom, owning assets that generate consistent and growing cash flow, letting compounding do the heavy lifting over time. With consistency and patience, anyone can build a portfolio that produces income, creating more choices, security, and ultimately financial freedom in the long term. It's not chasing quick profits, it's not trying to predict the market. One of the things that has been attractive to me is not having to think about timing the market, and since I'm going for dividends, it makes me much less likely to buy and sell and react. This isn't a trading type of thing. So I'm going to go over some funds that I'm looking at. I've said I'm going to try to look at new funds to try to diversify more. I'm going to show the weighting of the different funds that I have, and it's July 10th. So we've got a few more dividends that have come in, and we're going to see where we get to at the end of the month and into next month and see what the diversification is going to bring to the portfolio. So, right now, year to date, we've got $3,881 in dividends that have come in so far this year. We're a little halfway through the year. The projected, just kind of a quick and dirty, is should be about $8,000 for the year. We'll see if we hit that, and I can't wait for next year because when you see the graphs, we're just growing this, and it's fun to see where it's going. Right now, year over year, so this was started near ish the beginning of 2025, and I've been putting a lot of income into this. So in 2025, we totaled 15,000 and some change, and already in 2026, we're approaching 4,000, and we're also keeping track of all-time dividends for the whole portfolio, which is 5,430. So that's pretty good. But we also have to look at how the funds are actually doing. Just because we're getting these dividends, if the funds are going in the negative, then we're either just at break even and we're not really doing anything, right? So I have a couple graphs. This is the dividend growth. These are the dividend growth all time by year. So we started back in April of 2025, and that month brought in $9. We doubled it in May, then we doubled it again in June, and this is the sum total of the year. So this is stacking the sum of all the prior months. So that's where we ended 1,500 at the end of December, and then we started back over in January at zero. And so this graph is going up and to the right. So I'll do this every year to show we can compare like April this year to April last year, June this year to June last year, etc. So, hey, up and to the right, that's what we want. And this is sum totals for the whole year by calendar year. This is just and then this is all time, and this is the dividend payments for each month without the summation. So you can see we had I was in some higher risk um, dividends, some of those weekly payers that aren't really doing well. I was trying those at the beginning, so we had some payments in August and October that were a lot higher, but those funds were also just losing value. It's called NAV erosion, right? And so I basically got out of those at break even, and I think I'm much more diversified and overall in less risky funds. But I do still have some defensive ones and I have some higher risk ones. You can't totally go off the yield. You have to look at what the fund is doing. But the yield can be an indicator of risk, in my opinion. So we're going to look at the weights in the whole portfolio, which I haven't really shown very well before. But because there's a variety of funds that have different yields, and the yields can change as the value of the fund changes, but on average, the weighted average, so there's some higher yielding and some lower yielding. So the weighted average is about 12% annual yield just on dividends with the diversification that I have. This is helpful because instead of looking at just one fund in particular, if there's one fund that's paying 15% a year and another fund that's paying 6% per year, as these we want to average them out to help predict what is this going to do in the long term. So these are all the funds that I currently have. Some of these might be familiar to you. I haven't changed anything since the last video, but I wanted to find a way to show this information in an easier way, which I hope you appreciate. So some of these you've heard of: JEPQ, QQQI, and these are the annual yields that I got today. These can change, especially with the higher yielding ones as the fund changes, but as I've said before, some of these are more defensive. JAAA, JBBB, and clause are really defensive. The value of the fund shouldn't change much at all, but the annual yields pretty much hold steady. So if there is a pullback, something like that, these are kind of the defensive positions. SPYT and XPay, I think, are my riskiest positions, and this one has changed a little bit recently, so I usually pay close attention to SPYT as far as, am I really in the green or am I break even? Not sure how risky XPay is, but it's done very well for me. And then CLM is also a really high annual yield, and it's done great. So I try to update these as they change as best I can because, well, I need to see the weighted average. But overall, as a passive strategy, where I take care of these numbers and things, I really try to keep it easy because I don't want to be a trader. Compared to the last video, I did make some changes and I reduced some of the defensive JAAA, JBBB. I did reduce some of these positions and I think I increased GPIC a lot. I just want a little more income, and it's been doing fine. So these are all the funds if you're interested, and it's decently diversified. However, I have looked at some ways to diversify more. I haven't bought anything new yet, but I think all of these are pretty much US, and there are ways to diversify with income or dividend focused funds that are international. So I'm going to start looking at those. I don't do any REITs, haven't really been interested in REITs, but it could be a way to diversify some more. So I'm considering that. So this is the weighting that I currently have. So this might be pretty interesting to some of you. Um, some of them are larger, some are smaller. As you can see, the defensive ones, JAAA, JBBB, and clause. Before I made this video, they were larger, but between this and the last video, I did reduce them, and I put a lot more into GPIC and I think also QQQI. But, you know, this pie chart is a pretty good way to see, am I diversified? And I can see the weightings, 5%, 5%, 12%. So I am heavier on the larger paying funds. SPYT and XPay are each over 10%. But none of these stand out as, I don't have anything that's more than 12% of the portfolio. I don't necessarily have specific targets, but just looking at it in this way, I feel like it's decently diversified between different companies, meaning like management companies, things like that. Nothing is like taking a whole 25% of the graph, something like that. So let's keep going. These are the weights. Something I've talked about, but I want to visualize a little bit better and look into it more. So this is in Robinhood, and there's a difference between a in a in a dividend focused portfolio. The dividends are buying back into the funds, but that doesn't totally show in the return. So Robinhood shows something called a price return. So as of today, if I look at the fund just year to date, because it's been for more than a year, so the all time is a little higher, but I'm just want to focus on year to date. The year to date for the price return in Robinhood is 8.71%. So that's fine. However, the price return does not include the dividend payments. So if I take the total dividends and I put it on top of that, it brings my total return for the year to 13.75%, which is pretty good. If and we're not even fully through the year yet. So once we stack more dividends on top of this, which will be about double what has come in so far, this year to date, the total return with the dividends could be 15, 16%. If that was something that even 13%, if I could find out that I could count on that for a very long period of time, that's pretty good. And you could compare it against what the Nasdaq has done or things like that, the S&P 500, but I don't have to worry about just sitting in one big fund that has everything. The strategy is more for the dividends, and we'll see at the end of the year. I'll be able to do a comparison. I didn't do it today, but how is this 13.75% really comparing to the S&P 500, things like that for the year? Usually I was showing the dividend payments for the month, so this is just a way to do that. So far for July, and it's only July 10th, we've brought in $518, and I'm assuming it's going to hit at least $800. Maybe some of the funds had some kind of pullback with the dividends. It was a little unclear to me. I highlighted some of the ones that were a little bit bigger. The 152 and the 154, these are the SPYT and XPay. So really like to see those. And then we've got $47, $40, $41, and the total for the month so far, $518. So this is what some of you I think are interested in, what's actually coming in for the month. Next is the returns. So, again, this is the price return. We talked about up here, there's the price return, which is like the growth of the whole portfolio year to date without the dividends. And then the total return includes the dividends as like appreciation. So I haven't done that with the individual funds because it's just way too tedious. Um, so, but it is good to look at what's the price return without the dividends of these different funds, so I can see, are any of them really like giving me some kind of warnings or something like that. So overall, things are up. JEPQ, and I have a view of this that kind of shows it over time, but maybe I'll do that at the end of the year, something like that. But as of today, JEPQ's up, SPYI's up, QQQI is up, G picks up 7%. Uh, and then this is all time since we started this. This is not just year to date. I'm not really worried about these defensive ones. JAAA, JBBB, and clause. I mean, these are my main that are in the red, but these just kind of hold steady. I mean, they could be down 0.3%, they could be up 0.3%, but they pretty much don't really move. So these don't really bother me. SPYT is down. It's a huge dividend payer. So I have I do have something where I pay attention to what is SPYT doing compared to the dividends that it's paying. So as of today, that fund is down like $150, but all time it's paid about $1,000. So what does that mean? It's still up by a lot, even though the all-time return is saying it's down $150 or so. ASGI is also down, so I may take a look at that, but overall, I'm happy with all these. We can take a look at what is ASGI's return is 11% per year. So, once again, if the fund is down 1.2% by the end of the year, but the annual yield is 11%, I'm still ahead 10%. So this doesn't really worry me. And, we have market ups and downs. But mostly, even when some of these have been down as much as 4%, 5%, they've bounced back just fine. So um, I've been really happy with what this has been doing so far. Uh, Lastly, this comes from a compound interest calculator, and I've wanted to inspire people if I can. If a friend of mine doesn't invest at all, so this is a 30-year chart of if you were getting 12% per year. This includes growth and dividends. You started with 10 grand at year zero and you added $500 a month, for 30 years, you'd have just over $2 million. And I will go over again, you know, what types of income would that be? With something like this, if we're averaging 12% in dividends, $2 million should be about $200,000 a year. Yes, there's taxes. There may be taxes on top of that. That's kind of another topic, but for just a quick and dirty overview, and then we can also see at what year will we hit $1 million, which should be an income of 100 grand per year. So you're talking $10,000 a month or so, $9,000 a month. So just saving or investing $500 a month, you'd have about $1 million at year 24. And if you go to investor.gov, you look at their compound interest calculator, you can project out. You can say, well, what if we were doing $1,000 a month instead? Or what if we were only doing $300 a month? Would I still be able to retire with $1 million portfolio? What would that look like? What if I'm able to start with 20 grand instead of 1,000? What would that look like? Can I get to $1 million in 20 years instead of 24 years? Things like that. But this curve goes up and to the right, and at a certain point, it just really starts to take off. And, you know, for long term retirement and the income that I want for this without, playing any games, with leverage, without having to do trading, things like that. Um, this is really nice to see, where it's going to go in the future. I did look at some other funds in some different categories. So I'll get into this another time a little bit more, but other funds that pay somewhere between 6% to 15% per year. This one is with treasuries. Some of these have to do with real estate. These ones are preferred stocks, which I don't know as much about. This one's really interesting. This is based around utility companies. And this is the one I think, or maybe these two are international. Might be just this one, um, which might be what I need the most because based on what I currently have, I'm mostly US focused, which is fine, but if I want this chart to really reflect greater diversity, which is greater stability, greater security, if I can find something that will return 10% yields, 11% yields, that is in international or in utilities. This is in treasuries, which I think might be more just defensive, but it was saying this pays like 15% annual yield. So I want to be careful because I'm pretty happy with what I have going right now. Um, but I might slowly scale into some of the ones here that I like a little bit more. If you know something about these, you think any of these are good or bad for whatever reason, leave me a comment and um, we'll see if we hit the $800 for the end of this month. And I'll see you in the next video.